How the mega-rich avoid paying taxes. At Wesha TV we share limitless knowledge. March 22, 2021. It is rumored that some of the wealthiest Americans manage to pay less in taxes than some of their employees. They achieve this by one of two methods: doing their own financial and tax planning or paying someone to do it for them. Simple, isn't it? The point is that the rich are able to avoid taxes through legal processes. Some mega-rich may use sketchy methods to avoid taxes, and everyone's definition of sketchy is different. However, most of the mega-rich use superior understanding of the tax laws to take advantage of all of the legal methods available to reduce their taxes. Here are just a few of those methods. Capital gains management. Assets that are considered long-term capital gains, held for more than a year, are taxed at a 15% rate, or for the wealthiest Americans, a 20% rate that was introduced in 2018. Short-term capital gains are taxed at the ordinary income tax rate. The Tax Cuts and Jobs Act of 2017, TCJA, lowered the top tax bracket to 37%. Still, long-term gains enjoy significant tax savings. Any monetary stream that can be classified as a capital gain will be classified that way in order to take advantage of the rates. Gains will be timed to bring the greatest tax advantage. Losing ventures that result in capital losses can be used to offset capital gains. Tax loss harvesting, or the strategy of selling off poorly performing investments at strategic times and using the losses to offset capital gains, optimizes the positive tax effects. Estate and gift exemptions. Gift and estate deductions help bring down taxable income, but there is even more reason to take advantage of them now. Thanks to the new tax law, the deductions have been temporarily doubled. Individuals can now claim up to $11.18 million, compared to the $5.29 million limit per person in 2017. The exemption expires after the end of 2025, so the wealthy are taking advantage. Many of them are setting up long-term trusts, such as a Delaware Dynasty Trust, which allows wealth to be passed down from generation to generation, she said. While it is subject to income taxes along the way, it will not be taxed as a gift if it meets the limit and will not be subject to estate tax when money comes out. However, given the costs involved in setting up and running a multi-generation trust, it only makes sense when you have $5 million or more to commit. Charitable donations. Giving money to non-profit organizations has long been a way for the wealthy to get a deduction on their taxes. And under the new tax law, the amount you can deduct has increased to 60% of your adjusted gross income, up from 50%. One way the rich have been taking advantage of the deduction is creating conservation easements, said Feather Gill, who is also the national head of legacy and wealth planning at Abbott Downing in Winston-Salem, North Carolina. A big plot of land may have some intrinsic value. Maybe it is on a migration field for birds. Maybe it abuts a river, or maybe it is some green space in an area getting overly developed, she explained. Oftentimes you can work with land conservation trusts and you can take a charitable deduction for the value of the conservation easement that you put on the property. The average filer can, of course, also take a deduction for charitable contributions, but they have a higher hurdle to overcome. In order to do so, they have to itemize their taxes. The Tax Cuts and Jobs Act nearly doubled the standard deduction to $12,000 for individuals and $24,000 for married couples filing in 2018, so the itemized deductions would have to exceed those amounts. Thank you for watching. For more education video content, subscribe to our channel and hit a notification icon bell.